Welcome to the deep dive. Today we're looking at hard data that's forcing money managers to bet in two completely opposite directions.
It is. It's a real split personality market. We're unpacking the snapshot from January 14th, 2026.
And the mission is to figure out this grand contradiction. You have high interest rates pushing one way.
And at the same time, a whole lot of weakening economic data that's got people expecting rate cuts to come sooner rather than later.
So funds are splitting their loyalty, right? It's AI and tech on one side and, well, the oldest safe havens on the other.
That's the core backdrop. High rates, a bit of a year-end liquidity hangover, and weak prices boosting those rate cut hopes.
Okay, let's get into that core tension, starting with the rates. The 10-year U.S. Treasury yield is still, what, stubbornly high?
It's stuck right around the 4.17 to 4.2% range. And that's like gravity for high-growth stocks. It just pulls their valuations down.
And this isn't just about the long term. The market's plumbing, the short-term stuff is looking pretty jittery.
Very jittery. We have the data from the New York Fed from the end of last year, December 31st.
And it shows some real stress, doesn't it?
It does. The Standing Repo Facility, or SRF, saw usage hit $74.6 billion.
So that's banks needing emergency short-term cash.
Exactly. But here's the paradox. At the same time, the overnight reverse repo, the on-NRRP, still had about $106 billion parked there.
Wait, so nearly $75 billion is needed for emergencies, while over $100 billion is just sitting there with nowhere better to go.
That's the disconnect. It shows capital isn't flowing smoothly. It's being hoarded in some places and desperately needed in others. A very nervous market.
Okay, so that's the pressure. Now let's talk about the hope. The thing fighting back against all this is the weak data-fueling rate cut bets.
And the main catalyst here is inflation. The U.S. core CPI data came in remarkably soft.
How soft are we talking?
Just 0.2% month over month. On a year-over-year basis, that's only 2.6%.
That's a huge signal to the market that the Fed's hiking has worked.
Precisely. And it's not just prices. We're seeing employment start to normalize, too.
The latest jobs report.
Yeah, non-farm payroll growth slowed way down, only added 50,000 jobs, and the unemployment rate ticked up a bit to 4.4%.
But it's not a collapse, right? We're moving from super hot back to just normal.
Exactly. No systemic deterioration yet. But the market is betting on the trend, on the direction things are heading.
Which brings us to the great split, the capital flows. On one side, you have money pouring into AI and technology growth stocks.
Right, the big names, NVDA, Meta, GOG. The bet is that their growth, their AI-driven disruption, is so powerful it just overpowers the high interest rates.
And on the completely opposite side of that bet,
precious metals, a stampede into safe havens. It's a fascinating display of both optimism and, well, deep anxiety.
Let's talk numbers there. Spot gold is strong, around $4,600 an ounce. But the real shocker is silver.
Silver is the headline here. It surged to about $90 an ounce, maybe even a little higher.
And that's not just a rally. The report says it broke a historic high position. What does that signal?
When silver moves like that, with that kind of velocity, it's more than just a simple hedge. It suggests a real anxiety about long-term inflation or maybe even systemic risk. It's a very powerful statement of doubt.
So you have doubt in the metals market, but what about other risk assets? Let's do a quick crypto check.
Well, the VIX, the fear index, is still pretty low, around 15. And the crypto fear and greed index is just sort of neutral, around 45 to 50.
So not euphoric, but not terrified either.
Exactly. And Bitcoin is holding strong, near $95,000. But its continuation really depends on those ETF and options flows now, that institutional money.
Okay, so let's tie this all together for someone trying to navigate this. What's the recommended strategy?
With this kind of uncertainty, the main theme has to be defense first.
Which means using broad ETFs like VOO for the S&P 500 or QQQM for the NASDAQ as your core positions.
Right. And for those big AI names, you don't chase them. The strategy is phased accumulation. You buy on the pullbacks, and you keep a cash buffer.
And given that silver signal, hedging seems non-negotiable.
Absolutely. A moderate allocation to a gold ETF is smart. Silver is a bit trickier now because of that huge spike. It's more of a short-term trade that needs really strict risk control.
Finally, what about cash? How should people be managing their liquidity?
You have to keep your powder dry. That means holding cash or very short-term bonds so you can deploy it quickly when there's a real turning point in rates or sentiment. Flexibility is your best weapon.
So to synthesize it all, market direction is going to be decided by funding flows and the next few inflation reports from the Fed.
That's it. Strategy has to be about defense, phased deployment into growth, and very strict risk management.
A perfect summary. We've covered everything from that $74.6 billion in emergency repo usage to the, frankly, shocking $90 plus spike in silver.
Which leaves us with the final question for you to think about. If the market is so sure that soft CPI means rate cuts are coming, which is an optimistic view, how do you square that with the historic, almost frantic demand for silver? What long-term risk is that metal signal truly hiding?
Something to explore on your own. That's it for the snapshot. We'll catch you on the next deep dive.